Welcome back to Theta Fuse. It is Tuesday, February 10th, 2026. I want everyone listening to just take a second and look at their calendar. Just look at the year, 2026. Now, I want you to imagine looking at that same calendar, but the year is 2126.
That is a century from now. I mean, none of us are here.
Exactly. Or, well, maybe we are if the biotech sector pulls off some kind of miracle. But for all intents and purposes, that date belongs to science fiction. It belongs to, I don't know, Star Trek. But as of this morning, it also belongs to the bond market. Because Alphabet, the parent company of Google, just made a move that effectively tries to colonize the next century of finance.
It is a staggering headline. It really is. We're used to companies planning for, the next quarter or maybe the next fiscal year.
If they're really visionary.
Right. If they're really looking ahead, they've got a 5-year roadmap. But Alphabet has just issued a debt instrument, a bond that does not mature until the year 2126.
A 100-year bond. A century bond. I mean, just stop what you're doing and think about the sheer audacity of that. They are borrowing money today from investors today with the promise that they'll pay the principal back when our great-great-grandchildren are running the world.
It's the ultimate form of long-term investing, isn't it? And honestly, it sends a signal that is, well, it's deafening if you know how to listen to the bond market. It's not just about the timeline. It's about the sheer scale of the bet they are placing right now.
And that is what we are digging into today. This isn't just some piece of financial trivia. This is a signal flare. One of the largest, most data-rich companies in the history of capitalism is betting the house and the farm and the future on the AI infrastructure build-out. They are locking in capital for 100 years to build the brain of the future, and they're starting today.
And the market is absolutely eating it up. That's the scary part, or the exciting part, depending on how you look at it. The demand for this debt was just voracious. So here is the roadmap for this deep dive. We are going to deconstruct this massive $20 billion capital raise by Alphabet. We're going to look at the mechanics of it. Who even buys this stuff? I mean, who looks at a 100-year bond and says, yes, that fits my risk profile?
And we'll get into the duration matching logic there, which is fascinating in its own right. It's not what you think.
Then we are going to follow the money. Because $20 billion doesn't just sit in a vault like Scrooge McDuck. It flows. It flows downstream into what we call the pick and shovel plays. We're going to talk about Cisco's new hardware, this shock absorber chip, and why analysts are basically screaming that Broadcom is a gift at these levels.
And we can't ignore the meta layer, the layer on top of all of this. We have news on Cadence Design Systems using AI to build AI. It's starting to get recursive.
And finally, we will wrap it all up with our investment strategy of the day. Based strictly on the news hitting the tape this morning, where do you put your money? How do you position yourself in what is looking like the biggest infrastructure boom of our lifetime?
It's going to be a dense one today, but there is a lot of signal in all this noise.
All right, let's unpack this. The war chest. So Alphabet went to the bond market this week. Now, usually a corporate bond issuance is about as exciting as watching paint dry. Company needs cash, company sells paper, company pays interest. Boring.
Standard operating procedure. Happens every day.
Yeah.
But this was different.
How so?
Well, first, just the size. Alphabet went in looking to raise about $15 billion. Now, $15 billion is already a number that's hard to really comprehend. That's the entire GDP of a small nation.
Right. It's more cash than most S&P 500 companies see in a lifetime.
In a lifetime. And they wanted to raise that in a single afternoon. But the market? The market looked at that $15 billion request and it just laughed. Not because it was too much, but because it wasn't nearly enough. The order book, that's the list of investors lining up to give Google money, it peaked at over $100 billion.
Wait, $100 billion in orders?
Yes. For every single dollar of debt Alphabet wanted to sell, there were $6 or $7 from investors chasing it. It was a frenzy. It's what we call a flight to quality. In a world where there's geopolitical instability, where markets are volatile, investors look at Alphabet's balance sheet and they see something that's safer than a lot of sovereign governments.
And that says a lot about the state of the world, doesn't it? When a search engine company is considered a safer bet than an actual country.
It really does. So, seeing this insane demand, Alphabet upsized the deal. They tapped the U.S. high-grade market for $20 billion. This is split across 7 different tranches, so different maturities. But the one that has everyone on the trading floor talking is the sterling bond.
The British pound issuance.
Correct. Alphabet plans to sell a 100-year bond in sterling. This is incredibly rare. We have not seen a tech firm issue a century bond since the dot-com era. The last big one was Motorola back in 1997.
1997. Motorola. Okay, let's pause on that for a second because that
Uh-huh.
feels like a massive red flag. In 1997, Motorola was the king of the world. They had the StarTAC flip phone. They were building the Iridium satellite network. They looked completely invincible.
They did. If you were an investor in 1997, you thought Motorola was going to rule the entire 21st century. No question.
And I mean, Motorola Solutions still exist. They make police radios. They're a fine company, but they are not the ruler of the tech world. They got crushed by mobile phones, then smartphones. They completely missed the internet wave.
Exactly. And let's look at another example from the sources. JCPenney, the department store. They issued a 100-year bond.
And they went bankrupt, what, like 20 years later?
23 years later, to be exact. So history tells us that issuing a century bond is often a sign of peak hubris. It's a company basically standing on a mountain and shouting, "We are immortal." But the market is just a graveyard of companies that thought they were immortal.
So that brings up the big question. Why do investors buy it? If I'm a portfolio manager, why on earth would I lock up my client's capital for 100 years? The risks are they're infinite. Climate change, nuclear war, a regulatory breakup, or just the simple fact that in 100 years, search might be done via, I don't know, telepathy.
Well, you aren't buying it because you believe in the telepathy thesis. You're buying it because of math, specifically something called liability matching.
Okay, walk us through that, plain English.
Think about the buyer profile here. The ones buying this up are mostly UK pension funds and big insurance companies, and these institutions have very specific, very difficult problems. A pension fund takes money from a 25-year-old worker today, and it promises to pay them a salary when they retire at 65, and then keep paying them until they die at maybe 95.
So they have a financial obligation, a bill that they have to pay that is 40, 50, 60 years in the future.
Exactly. That is a long-duration liability. To be safe, to make sure the money is there, they need an asset that matches that duration. They need something that pays out reliably in 60 years.
And there aren't many things that do that.
There are almost none. Most government bonds, even the long bonds, they tap out at 30 years. So when a AAA-rated or effectively AAA company like Alphabet comes along and offers a 100-year instrument, these pension funds treat it like water in the desert. They just gobble it up.
So it's not really about believing in Google's long-term dominance. It's about balancing a spreadsheet.
Precisely. It hedges their interest rate risk over the ultra-long term. It's a structural trade for them. But for Alphabet, it's a coup. They get to lock in relatively cheap capital for an entire century. It's essentially free money to go and build the future.
And that brings us to the why. Why does Alphabet, a company that practically prints money, need to borrow $20 billion? They are sitting on a mountain of cash.
This is the critical distinction between being cash-rich and CapEx hungry. Yes, they have cash, a lot of it. But the bill that is coming due for this AI infrastructure build-out is unlike anything we have ever seen in the history of technology.
We are seeing numbers that don't even seem real. The sources say Alphabet expects to spend somewhere between $175 and $185 billion in 2026 on CapEx.
Let's just sit with that number for a second. $185 billion in 1 year.
That's double what they spent the previous year.
And it's more than the 3 years prior to that combined.
Yeah.
We're witnessing an exponential ramp in spending. This is not a line, it's a hockey stick.
And just so we are all on the same page, when we say CapEx, or capital expenditures, we aren't talking about paying software engineers or buying snacks for the break room.
No, that's OPEX operating expenses. CapEx is hard assets. This is real estate, buying land, pouring the concrete for the foundation, building the steel structures, installing these massive industrial cooling towers because these chips run so hot they can literally boil water, and of course, the silicon itself.
The servers.
The servers, the racks, the networking cables, the fiber optics. This is the physical plumbing of the internet. It is an industrial construction project on a planetary scale.
And they are not alone in this. The notes we have mentioned the big six hyperscalers, Amazon, Google, Meta, Microsoft, Oracle. Combined, they are on track to spend $500 billion this year.
$500 billion. It's a number that just breaks your brain. That is roughly the GDP of Belgium. Or Sweden. Imagine the entire economic output of a country like Sweden being poured directly into data centers in a single year.
So that is why they are borrowing. Even for a giant like Google, $185 billion is a lot of cash to burn through.
Right. You don't want to deplete your entire war chest on construction. So you leverage, you use the bond market to pay for the bricks and mortar so you can keep your cash on hand for strategic acquisitions or R&D or whatever comes next.
It's an incredibly bold bet. They are essentially saying we are going to build the infrastructure of the 22nd century, and we're going to borrow from the 22nd century to pay for it.
And that is the key takeaway for you listening right now. When $500 billion moves, it creates a tide. It creates waves. And if you are an investor, you do not want to stand in front of that wave. You want to surf it.
You want to know where that money is landing.
Exactly. Alphabet's expense is someone else's revenue. Every single dollar they spend on a server is a dollar of revenue for a hardware company.
Which transitions us perfectly to the hardware wars. We have two major updates today from the companies that are essentially the arms dealers in this war, Cisco and Broadcom.
The pick and shovel plays. It's an old investing cliche, but it has never been more relevant than it is right now.
Let's start with Cisco, ticker CSGRUP. Now, I have to be honest here. When I think of Cisco, I think of beige boxes. I think of the 1990s. I think of the router in my office closet that I have not touched in 5 years.
The plumber of the internet. Yeah, it's not a sexy reputation. For a long time, Cisco has been considered dead money by growth investors. It's a value stock, it pays a dividend, it's reliable, but it's not Nvidia. It's not exciting.
But they are trying to change that. They just unveiled this G300 AI networking chip.
And this is a very significant move for them. They are trying to prove they aren't a dinosaur from a bygone era. The G300 is built on TSMC's 3-nanometer process, which is the absolute bleeding edge of fabrication. But the claim they're making is what really caught my eye.
They say it helps AI computing jobs get done 28% faster.
And that is a massive number. In this world, time is literally money and electricity. If you can train a model like GPT-5 or Gemini 28% faster, you are saving tens of millions of dollars in power costs. You're getting your product to market months earlier than your competitors.
But how does a networking chip speed up the computer? I always thought the GPUs, the Nvidia chips, did all the thinking. Why does the plumbing matter so much?
This is a great question, and it's where a lot of people get lost in the weeds. We have to understand how AI training actually works. It's not one giant supercomputer doing all the math. It is a cluster. It's 20,000, maybe 50,000 GPUs all wired together.
Like a giant hive mind.
Exactly. And they have to talk to each other constantly every microsecond. They're sharing parameters, gradients, little bits of data. Now, if chip A finishes its little piece of math, but has to wait for chip B to send its results over the network, chip A just sits there, idle.
It's just waiting for the email to arrive.
Right. And that idle time is wasted money. Big money. The source uses a great analogy for what this new G300 chip does. It's a shock absorber.
I love that. Break that analogy down for us.
Okay, so imagine a highway. That's your network. In a normal data center, traffic is pretty predictable. It's like driving at 2 a.m., smooth sailing. But AI workloads are what we call bursty. All of a sudden, all 50,000 GPUs scream out a massive amount of data at the exact same millisecond.
An instant rush hour. Complete gridlock.
Exactly. It creates a traffic jam. In networking terms, we call it congestion or tail latency. Packets of data get dropped. The data has to be resent. The whole system just stutters and slows down.
So the G300 fixes this traffic jam.
The G300 acts like a hyper-intelligent traffic control system. It sees the jam forming in microseconds and instantly reroutes the data to what you can think of as side streets. It balances the load across the entire network fabric so the traffic never, ever stops moving.
So it's not making the car itself faster. It's making the road system so efficient that the car never has to hit the brakes.
That's the perfect way to put it. And if the cars never hit the brakes, the whole journey, the AI training run, finishes 28% faster. That is the entire value proposition.
It's a really smart move. Cisco is essentially saying, look, we know Nvidia owns the car, the GPU, but we want to own the road.
And they're betting that enterprises, big banks, healthcare companies, governments who already have a long-standing trust with Cisco will buy this road for their private AI clouds. It's a defensive move to protect their turf, for sure, but it's also an offensive move to capture a slice of that massive $185 billion CapEx pie.
But the market, from what I'm seeing, still seems a little skeptical of Cisco. It's a show-me story.
It is, which is why we need to pivot to the company that the market is absolutely drooling over today, and that's Broadcom.
Broadcom, symbol AVGO.
Yeah, so we have a research note here from Jordan Klein at Mizuho. And he is not mincing words at all. He calls Broadcom in the low 300s a gift.
A gift. Wow.
You rarely hear analysts use that word. They usually say something like a constructive setup or an attractive entry point. They use these weasel words. Calling a stock a gift is like shouting from the rooftops with a megaphone.
So why is it a gift? What makes Broadcom the chosen one in this story?
It connects directly back to that Alphabet bond we started with. We said Google is spending $185 billion. Well, estimates say about 60% of that is for servers. But here is the secret that a lot of people miss. Google doesn't just buy Nvidia chips.
They make their own.
They do. They're famous for it. The TPU, the tensor processing unit.
We should probably explain this. Why does a company like Google go through all the hassle and expense of designing its own chip when they could just call up Nvidia like everyone else?
Think of it like a suit. Nvidia says the ultimate off-the-rack suit. It's an Armani. It fits almost everyone. It looks great, and you can wear it to a wedding, a funeral, or a business meeting. It's general purpose. That's what the G in GPU stands for.
It does everything pretty well.
Right. But because it's designed to do everything, it has features you might not need, and it's very expensive. Google looks at its specific workload and says, we don't need to do graphics. We don't need to do physics simulations for video games. We just need to run our specific AI code as efficiently as humanly possible.
So they want a bespoke suit, tailor-made.
They want a suit tailored down to the millimeter just for them. That is the TPU. It is an ASIC and application-specific integrated circuit. It does one thing and one thing only, and it does it with incredible power efficiency.
And who is the tailor in this analogy?
Broadcom. Broadcom is the key partner that helps Google design and manufacture these custom chips. They provide the crucial IP, the SerDes, which are the communication blocks, and the relationships with the foundries like TSMC.
So let's connect the dots here. Alphabet raises $20 billion, the earmark it for CapEx. They decide to build more of their own TPUs to reduce their reliance on Nvidia. And that money, it flows directly to Broadcom.
It is a direct pipeline, a fire hose of cash. Broadcom's AI chip revenue rose 65% to $20 billion in fiscal 2025. That is hyper-growth for a company of this size. And the analyst's argument is that Broadcom is the single best way to play the custom silicon trend.
Because it's not just Google anymore, right? We're hearing Meta is building its own chips. Microsoft is building its own chips. Amazon has Trainium and Inferentia.
Exactly. All the hyperscalers are trying to break free from Nvidia's monopoly, and Broadcom is the arms dealer helping them all do it. So if you believe in the war chest, if you believe that $500 billion spend is real, Broadcom is sitting right in the splash zone of that cash wave.
It's the classic pick and shovel play. Don't just bet on the gold miner, in this case Google. Bet on the guys selling the high-tech excavators.
And in this case, Broadcom is selling the most advanced, custom-built excavators on the planet.
I want to take a quick pause here. We are throwing a lot of numbers and tickers at you, I know.
Yeah.
If you are finding value in this deep dive, if you're enjoying connecting the dots from the bond market all the way down to the chip market, make sure to comment and subscribe to Theta Fuse. We are building a community here of people who want to understand the why behind the market moves.
Absolutely. And here is your favorite section. If you need a deep dive analysis on a specific stock symbol, maybe you're looking at Palantir, maybe you're looking at AMD, drop it in the comments. We look at them, and we will pick the best ones to feature in our next podcast.
Okay, let's get back to it. Segment 3, we've talked about the money, which is Alphabet. We've talked about the hardware, Broadcom and Cisco. But there is a bottleneck in this whole process we haven't discussed yet.
The complexity bottleneck.
Yeah, these chips, the G300, the TPU V6, they are getting so mind-bogglingly complex that the human brain can barely comprehend them anymore. We are talking about billions and billions of transistors on a sliver of silicon the size of your fingernail.
We are hitting the absolute limits of biological engineering. You simply cannot draw these blueprints by hand anymore. It's impossible.
And that brings us to the meta layer of this story. AI building AI. Now, this sounds like the start of a Terminator movie, but it's actually a company called Cadence Design Systems.
Cadence, ticker CDNS. They are a fascinating company. They operate in a duopoly with another company called Synopsys. They make what are called EDA tools, electronic design automation.
Which is basically Photoshop for computer chips.
That's a simple way to put it, but it's so much more than that. It's Photoshop combined with a physics simulator combined with a logical debugger. It's the software that the chip engineers use to design these incredibly complex chips.
And the news today is that they are integrating AI into this process in a really big way. They launched something called the ChipStack AI Super Agent.
The Super Agent, it's a great marketing name, sure, but the problem it solves is very, very real. The source material mentions that chip engineers, some of the smartest, highest paid people in the world, spend up to 70% of their time just debugging code. 70%.
Yes, 70. They write the code, usually in a language called Verilog, And then they just stare at it for days, for weeks, trying to find the missing semicolon or the one tiny logic error that's breaking the whole design.
That is an incredible waste of human capital.
It is a massive waste. So Cadence built an AI that can understand the intent of the design. It builds a mental model of what the chip is supposed to do, and then it goes in and autonomously finds the bugs and even suggests fixes.
So it doesn't just spell check. It actually understands the logic of what the engineer is trying to build.
That's the claim. And the quote from Paul Cunningham, the VP at Cadence, really sums up the whole shift. He said they are moving from selling tools to renting you virtual engineers.
Renting you virtual engineers. Wow. That is a powerful concept. It changes their entire business model.
It does. It's like the difference between selling someone a hammer and renting them a master carpenter. If you rent them the carpenter, the house gets built a lot faster. And in this race, where Google is spending $185 billion, speed is everything, they want those TPUs designed and working now, not in 3 years.
Exactly. And we have to touch on the geopolitical angle here, the U.S. versus China.
It always seems to come back to that, doesn't it?
It does. Analysts have pointed out for years that China has a volume advantage. They graduate way more engineers than the U.S. does. If chip design is a manual labor game where you just throw more bodies at the code, China wins eventually.
Just purely on headcount.
Right. But if chip design becomes a tool leverage game, if you have AI agents that act as force multipliers,
then the headcount matters a lot less.
Exactly. If one U.S. engineer using the Cadence superagent can do the work of 10 engineers using the old methods, then the U.S. maintains its technological edge.
So Cadence isn't just a software company. It's, in a way, a national security asset.
In a way, yes. It is the efficiency layer that allows the West to compete against the sheer demographic weight of the East.
That is a fascinating way to look at it. So, okay, we have the money, we have the hardware, and we have the software. It feels like a complete stack. But
there's always a but. Always a fly in the ointment.
Nothing in finance goes up in a straight line forever. We have to talk about the speed bumps. And that brings us to segment 4, the regulatory wall.
We have news out of Europe today, specifically the European Publishers Council.
They have filed an antitrust complaint against Google. And this is about those AI overviews we're all seeing at the top of our search results now.
You know the ones. You type, "How do I boil an egg?" into Google. And instead of just giving you a link to a cooking blog, Google just tells you how to boil an egg right there on the page.
The zero-click searches.
Exactly. It's super convenient for you, the user, but it's catastrophic for that cooking blog.
Because I don't click on their link, so they don't get the traffic. They don't show me the ad. They don't get paid.
Right. And the publishers are, to put it mildly, furious. Their argument is essentially, Google, you scraped our content to train your AI, and now you are using that AI to steal our audience. You are using our own work to put us out of business.
And they want to get paid. The phrase they use is fair remuneration.
They want a cut. They want licensing fees for their data.
Okay, so how does this impact our whole thesis? We just spent the last half hour talking about how Google is going to take over the world with this massive spend. Does a lawsuit in Brussels stop a $20 billion bond issuance?
It doesn't stop it. But it could make the whole endeavor more expensive. We've been talking about CapEx, the cost of chips in data centers. But there is also the cost of data itself.
The OGS, the cost of goods sold for an AI model.
Right. Right now, the hyperscalers treat data like it's air. It's free. They just breathe it in from all over the internet. But if the courts in Europe, and maybe eventually here, rule that data is actually like oil, that you have to pay for every barrel you extract, then the fundamental economics of AI change overnight.
That $185 billion budget might need to go to $200 billion. Or the profit margins on all these new AI products might get squeezed pretty hard.
Exactly. It introduces friction, it creates legal risk and uncertainty, and markets absolutely hate uncertainty. It's a powerful reminder that while the technology is moving at an exponential pace, the law is very linear, and the law is starting to fight back.
So what we have is a powerful bull case driven by massive spending and technological breakthroughs. And on the other side, we have a bear case driven by regulation and the sheer risk of taking on all this century-long debt. It's a tug of war.
As it always is in the market.
So, with all that said, how do we play it? Let's cut through all the noise. It's time for our investment strategy of the day.
Okay. And to be clear, we are looking at this strictly based on the sources we have in front of us today. We are not guessing. We are reacting to the tape.
What is the overarching theme?
The theme is what I'm calling the infrastructure-weighted basket.
Unpack that for us.
The logic is simple. The hyperscalers, like Google, are the ones spending the money. The suppliers, like Broadcom and Cisco, are the ones receiving it. The sources today suggest that the smart move is a rotation into the suppliers. You want to own the cash register, not just the customer spending the cash.
Okay, let's talk specific tickers. First up, Broadcom, AVGO.
This is your aggressive play. This is the growth engine of your basket. The analyst we cited called it a gift. That is your signal right there. The thesis is that Google's record-breaking spend is specifically targeted at custom silicon to get away from Nvidia, and Broadcom is the undisputed leader there.
So what's the action? What do you do?
You look for pullbacks. If the broader market dips, if the stock is trading in the low 300s, the source suggests this is undervalued relative to the wave of cash that is coming its way. You are essentially buying the dip on a massive secular trend.
Okay. And what about for the more conservative investor?
Yeah.
The one who likes dividends and a little less volatility.
That would be Cisco, CSCO. This is your value or your turnaround play in the basket.
And why Cisco?
Look at the valuation. It has a PE, a price-to-earnings ratio, of about 30.2. The industry average is 32, so it is trading at a discount to its peers. It's also currently trading about 9% below the consensus analyst price targets.
So it's on sale, basically.
It's cheaper, it's less volatile, it pays a solid dividend. If you believe this new shock absorber chip can create a new revenue stream for them, Cisco is a much safer way to get exposure to the AI build-out without the stomach-churning volatility of a pure-play chip stock.
So the strategy in a nutshell: buy the gift, Broadcom, and monitor the turnaround.
That's the trade. Build the road before you bet on which car is going to win the race. Infrastructure over application.
And as always, we have to say the magic words.
We do. The content of this podcast is for informational purposes only. Everyone's financial situation is different, and the thoughts we provide here may not be applicable to you. We are not financial advisors. Please consult with a professional before making any investment decisions.
All right, so let's bring it all home. We have covered a massive amount of ground today.
We really have.
We started with Alphabet, literally betting the next 100 years on AI, raising $20 billion to build out a war chest.
And we followed that money as it flows into the pockets of Broadcom and Cisco, who are building the physical plumbing of this new world.
Then we look at the meta layer, Cadence, the AI that builds AI, which is speeding up the entire process.
And we wrapped up by touching on the regulators in Europe who are trying to put some speed limits on this technological autobahn.
It is a truly fascinating ecosystem. But I want to leave you with one final thought, a provocative thought to chew on as you go about your day.
I'm ready. Lay it on me.
We talked about that Alphabet bond maturing in the year 2126. By issuing it, Alphabet is making a massive assumption that they will still be the dominant information power in the 22nd century.
It's an incredibly bold assumption, to say the least.
But we also talked about Cadence's virtual engineers. These are AI agents that can design chips, debug code, and arguably eventually manage entire projects.
I see where you were going with this.
If these AI agents continue to evolve at this exponential pace, by the time that bond finally matures in the year 2126, will a human even be the CEO of Alphabet?
That is a profound question.
We might be building a future where the company itself is simply an autonomous algorithm, a self-driving corporation. It services a debt, it pays the pension funds, and it builds new servers, all without a single human ever attending a board meeting.
The post-human CEO? Wow. If the virtual engineer becomes the virtual CEO, then that 100-year debt is just another variable in a giant database being managed by a machine. It's a terrifying and an exhilarating thought at the same time.
If that happens, I just hope the AI CEO decides to pay a dividend.
We can only hope.
Something null over while you watch the ticker today. Keep your stops tight and your eyes on the tape. We'll see you tomorrow on Theta Fuse.